So let us continue our discussion on the financing decisions. And when a company issues shares or raises capital or finances business with capital, so what is the commitment of the company? What is the obligation of the company? By default, capital is not to be refunded, but whenever the company issues shares, there is an obligation, possible obligation, that they have to declare dividend or maintain the operations in such a way that the company's price in the market will go up and the shareholders will benefit. So the buyer of share expects a dividend as well as the capital appreciation. So the return for the shareholder is a capital appreciation plus dividend. So this time let us try to understand and focus on the dividend. The dividend is a distribution of profit among the shareholders. However, dividend is not compulsory. The management may decide to give dividend or may not decide to give. So when a company makes profit, it's the management decision to retain the profit or distribute the profit. If the profit is to be distributed, and that's called dividend, and the dividend can be distributed by the company either in the form of cash or in the form of stock. So dividends can be cash dividend and stock dividend. Let us see the difference between these two. Cash dividend, if a company distributes cash dividend, the cash goes out of the company and reserves goes down to that extent. As a result, the net worth of the company goes down. And when the net worth of the company goes down, the book value of the company, that is net worth divided by number of shares, that is the book value per share, comes down. So when the book value per share comes down, invariably, all other things remaining constant, the price of the share falls. That means when a company declares dividend, the price of the share comes down, controlling the other factors. So is the case with the stock dividend. Stock dividend is also called bonus issue or bonus shares, and that means you are capitalizing the reserves into capital. So when a stock dividend is issued, the reserves reduces, capital goes up, but the net worth remains constant and cash does not go out. Though the net worth remains same, since the number of shares goes up, the book value per share in this case also falls. So in both the cases, the book value per share falls. As a result, in both the cases, if there is no other positive information, the price of the share will go downward. So obviously a question comes that will a shareholder expect a company to give dividend, or will the shareholder expect the price to go up? If you see, most of the companies do both. For example, if I pick up any IT company in the last 2 to 3 years, I've seen that most of these IT companies, good IT companies in India, have given declared a dividend in the range of 100 to 200 or 250% of the face value, which results in about 2 to 5% dividend yield. So that means these companies are giving dividend on the face value, but the price is so high, but the rate of the yield is around 2 to 3%. But if you see the rate of dividend for an FMCG company, it's very high. Companies like Colgate Palmolive has often given, in fact in 2009 it has given a dividend in the range of 800%, and the yield is about 2.5%. So most of the FMCG companies have also given dividend, and that to very high percentage, and most of the time is higher than an IT company. And also the yield of these FMCG companies is also higher than the yield of IT companies. So it shows that most of the companies in India, both IT and FMCG, give dividends and also benefit the shareholder because of the appreciation of the shares. So to summarize, I'll say that the distribution of dividend as a decision is an important decision for the company because it affects the cash, it affects the net worth, it affects the book value per share, and in the process it affects the market price of the share. By announcing that I'm not going to declare dividends, companies are sending a signal. So dividend acts as a signal to the shareholder. As a result, price fluctuates. So dividend decision is a part of the financing decision, should be considered keeping in mind the profit, cash and the price. Thank you very much.